Welcome to the Deep Dive. Today, we're looking at a market narrative that is, well, it's arguably the most paradoxical one we've seen all year.
It really is.
You've probably heard that old trading mantra, bad news is good news. But right now, global markets are treating genuinely bad U.S. economic data like it's the best news possible.
An invitation to a massive party, basically.
Exactly. Stocks are soaring, risk assets are absolutely loving it.
And that's the paradox we need to break down. Our mission today is to dissect exactly how Wall Street, Asia, Europe, currencies, commodities, how all of it is reacting to this one single overriding conviction.
Which is?
That the Federal Reserve has no choice. It must pivot and cut interest rates, and probably as early as December.
So there's this huge gap opening up between market hope and economic reality.
Yeah.
Stocks are just celebrating the idea of cheap money.
Right. But as we'll see, that optimism is masking some really significant structural risks.
Okay, like what?
Specifically, a major vulnerability in the AI chip supply chain, which has been the engine of this rally, and a kind of brewing illiquidity crisis in U.S. housing.
So the whole party is just built on monetary expectation.
Purely. So we're going to dig into the hard numbers that have given traders this, near certainty about the Fed's pivot, and then we'll look at the specific weaknesses that are being exposed while the indexes just keep climbing.
All right, let's do it. Let's unpack this conviction. The probability for a December rate cut is now priced at almost 85%.
It's an overwhelming consensus.
It's not just a lean, it's a sure thing in the market's eyes. What specific data cemented this belief?
It all starts and ends with the U.S. consumer. They've finally broken. The most critical data point was the Conference Board Consumer Confidence Index, the CCI.
And it was bad.
It plummeted to 88.7 in November. Now, just for context, analysts were looking for something like 93.2. This wasn't just a miss, it felt like a surrender. It's the lowest reading we've seen since April.
Okay, so that's the present condition, how people feel right now. But the market's always looking 6 months down the road. What about future demand?
And that's where the real panic signal lies. The expectations index, which is the part that gauges the outlook for 6 months from now, it fell even harder.
How much harder?
It tumbled 8.6 points to 63.2. The report said consumers are, and I'm quoting here, notably more pessimistic about business conditions 6 months from now.
Which translates directly to lower spending.
Directly. But the really alarming part, the part that got everyone's attention, was that expectations for future household incomes shrunk dramatically. That's the signal. After a pretty stable trend, that kind of reversal suggests the average person has just lost confidence in their financial future heading into 2026.
And a consumer pullback of that size, it has to show up in the big growth models, right?
Did we see that reflected in GDP tracking?
We did. It was subtle, but the direction was unmistakable. The Atlanta Fed's GDPNow estimate, which is very closely watched, saw a small but I think strategically significant decline. It fell from 4.0% to 3.9%. Now, 0.1% doesn't sound as a lot.
It doesn't, but you have to look at why they moved it. The reduction was pinned specifically on a lower nowcast for real gross private domestic investment. That fell from 4.4% down to 3.5%.
Ah, so it's not just people buying less stuff. It's businesses seeing that, and then they decide not to invest. They're pulling back on capital spending.
Precisely. They won't invest if they don't see future demand. So when you have consumers this pessimistic about their future income, businesses pull back. That's the feedback loop. And that softening growth signal makes the Fed's current stance, their restrictive policy, look almost unsustainable.
And then you have the political angle, which always feeds into these expectations.
Absolutely. The market is so sensitive to any perceived political shifts at the central bank. And the news that Kevin Hassett has emerged as a frontrunner for the next Fed chair just bolstered those expectations.
Because he's seen as someone who would favor lower rates, more accommodative policy.
Exactly. The market reads that as, okay, the chance of the Fed making a mistake and staying tight for too long just went down. You put the data and the political signals together, and you get very high conviction.
So the fear of a recession, signaled by the consumer, is now the ultimate bullish catalyst for stocks. It's just wild. How did the global markets react?
The reaction was swift, and it was universally positive, all of it driven by that rate cut hope. On Wall Street, you saw a big rally. The Dow gained a robust 1.43%. The S&P was up 0.91%, and even the Nasdaq added 0.67%.
And that optimism, I assume, didn't just stay in the U.S.
Not at all. It went global. Asian markets were strong. led by Japanese tech stocks like Advanced and SoftBank. European stocks, the STOXX 600, were set to open higher. And even in emerging markets, you saw positive signs.
Right.
For instance, the IHSG in Indonesia is now expected to resume its uptrend, which is pretty significant because foreign money had been flowing out of that region. It was a classic risk-on move.
All based on the expectation of cheaper money. Okay, but inside that big tech rally, you're flagging a major vulnerability. Something exposed right at the foundation of the whole AI boom. Let's talk about the Nvidia challenge.
Yeah, this is, I think, much more than a short-term headline. It's a potential structural threat to the single most dominant player in AI hardware.
And the catalyst was Meta.
The catalyst was Meta Platforms, one of the biggest chip buyers in the world, saying they are exploring using Alphabet's proprietary chips, their tensor processing units, or TPUs.
Instead of just relying on Nvidia's GPUs?
Exactly. They're looking to use TPUs in their data centers, targeting a 2027 deployment.
Okay, hang on. For anyone listening, what exactly are TPUs, and why is this plan, which is years away, such a big deal for Nvidia today?
So TPUs are Alphabet's own custom-built silicon. They're designed from the ground up specifically for machine learning. Think of them as a competing architecture to NVIDIA's famous GPUs.
A direct competitor.
A direct and very powerful competitor. The fact that a giant like Meta is even exploring a large-scale shift, it signals that the era of, total NVIDIA dominance might be peaking. It's all about cost and efficiency in the long run.
And the market reacted immediately.
Instantly. NVIDIA shares fell 4% on the news. On the flip side, Alphabet, whose whole proprietary silicon strategy was just validated by this, gained more than 4%. It was a direct hit.
So if we connect that to the bigger picture, what does this mean for, the millions of investors who hold those broad tech ETFs?
It exposes a really acute and I think often hidden concentration risk.
How so?
Well, a lot of popular market cap-weighted ETFs are just hugely dependent on NVIDIA. Take the VanEck Semiconductor ETF, SMH. NVIDIA is a staggering 18.5% of its assets.
18% in one stock. Wow.
Or the Global X Robotics and AI ETF. That one holds NVIDIA at almost 12%. So if you hold that fund, you're not really diversified. You're making a huge directional bet on a single chip maker that is now facing a structural threat.
So fund structure matters just as much as picking the right sector.
It absolutely does. And you can contrast those funds with something like the Robo Global AI ETF. It uses a fundamentally weighted index, and it holds NVIDIA at just 2.25%. They've hedged that single stock risk, allocating more to competitors. This news just proves how valuable that diversification can be.
Okay. Moving from digital infrastructure to physical, the U.S. housing market data is equally grim, but we aren't seeing that catastrophic price collapse that a lot of people predicted. What's stopping it?
This is what we're calling the inventory paradox, and it is driven almost entirely by seller behavior. The market is just stuck.
Stuck how?
Homeowners who locked in those super low mortgage rates a few years ago are just refusing to sell at today's lower values. They're choosing to wait it out.
So instead of lowering their price, they just pulled a listing off the market entirely.
Exactly. The data here is striking. Close to 85,000 U.S. sellers delisted their homes in September. That's a 28% increase from a year ago, and it's the highest level for that month in 8 years.
They'd rather just stay put.
They'd rather stay put or rent it out than accept an offer that's shaped by today's high mortgage rates.
And that seller strike is creating a massive stagnation. Homes just aren't moving.
They are not. 70% of listings in September were on the market for 60 days or longer. And this withdrawal of inventory, it artificially props up prices because there's less available supply, even though demand is really weak. It's structural illiquidity.
But for the homes that do stay on the market, the pressure must be intense. Are we seeing big price cuts there?
We are. The agony for the remaining sellers is very visible. The typical listing saw about $25,000 in cumulative price cuts in October. That matches the largest discounts Zillow has ever recorded.
Wow.
And for those who finally gave up and delisted, about 15% of them were at risk of selling at a loss. That's the highest share in 5 years. So you have illiquidity, stagnation, and high seller distress, all waiting for the Fed to cut rates.
Which sets the stage perfectly for global capital flows. The expectation of a Fed pivot weakens the dollar, and that immediately changes everything. How are currencies and commodities responding?
The dollar weakness is rapid. The U.S. dollar index, the DXY, fell 0.5% to 99.746, and it's driven entirely by that weak U.S. data and the rate cut hopes.
And when the dollar weakens, other assets look better.
Instantly. Risk-sensitive assets all around the globe become more appealing because they're cheaper for international investors to buy. We saw immediate gains in currencies like the South African rand, which strengthened 0.5% against the dollar. It's a clear signal that capital is starting to flow back to those regions.
Okay, and what about gold, the classic safety hedge? It seems to be having a huge moment.
Gold is benefiting from this really powerful dual dynamic. There's a cyclical driver and a secular one.
Okay, what's the cyclical driver?
That's the standard stuff. Lower prospective interest rates and a weaker dollar. That's classic support for gold. Spot gold was trading near, 41.73 an ounce? But the secular driver is what's truly significant here.
Which is?
Deep-seated geopolitical risk and, critically, a growing mistrust in the dollar.
Why is that mistrust accelerating right now?
Well, you're seeing central banks around the world fundamentally repositioning away from total reliance on the dollar. The EU is actively trying to use frozen Russian central bank assets to fund Ukraine. And that action sends a clear signal to every other country holding large dollar reserves. Your assets are vulnerable to political action. As a result, central bank gold buying has just exploded. It now accounts for almost 26% of net global demand.
And what was it before?
It was only about 15.5% back in the 2010s. This is a deliberate, long-term strategic shift away from the dollar.
Finally, let's check in on crude oil. It often tells a different story about global growth. Is oil celebrating the rate cuts, or is it worried about the consumer?
Crude is really mixed right now. It's caught directly between a long-term structural worry and short-term volatility.
So on the one hand,
we saw Brent and WTI futures drop about 1.5%. That's because of a fundamentally bearish view centered on a 2026 oversupply. Deutsche Bank, for instance, is projecting a surplus of at least 2 million barrels per day for 2026. That's a serious headwind.
structurally bearish, but what about the short term?
Short term is all about geopolitics. Prices were pushed down a bit by reports that Ukraine had agreed to a peace plan framework. But at the same time, you have fears over potential supply disruptions from Russia, like recent drone attacks on refineries, and that's putting a floor under prices. It's a very conflicted commodity.
Worried about a future glut and an immediate shock at the same time.
Exactly.
So to summarize for you, the listener, the immediate market action we're seeing is all about celebrating that 85% probability of a rate cut.
It's all monetary expectation. But the underlying data that we've just dissected, from the consumer confidence collapse to the housing stagnation and the major new competition facing AI chip dominance, it all suggests a significant and persistent structural weakness.
A weakness that cheap money might only be able to mask temporarily.
That's the risk.
The dichotomy is just fascinating. You have illiquidity locking up the housing market, a huge concentration risk being exposed in the tech sector's foundation, yet stocks just keep climbing on hope. The entire bet is on the Fed.
Which leaves us with a really provocative thought to end on. The market is now completely 100% reliant on the Federal Reserve executing this pivot, on delivering on that 85% probability.
So the question is,
given the sheer unexpected depth of that consumer confidence drop we talked about, what happens if the Fed, for any reason, maybe a sticky inflation print, decides to delay, or even just reduce the magnitude of that cut?
what happens to that 85% certainty?
Exactly. That total reliance and the potential domino effect if those monetary hopes are dashed even slightly, that is the real uncertainty facing you, the investor, today.